So what constitutes a revenue? Well, when it is earned. Earned means that you have done what the customer wanted you to do. In the case of a product, you have delivered the product. In the case of the service, you have provided it. Hotel room, legal representation, consulting job, a concert. So let us say it is recorded as revenue if delivery of the product or service has occurred. But delivery is not enough. We should also have reasonable assurance that the customer will pay us. Normally, this is all good at the point of sale. Of course, there are many exceptions, such as long-term contracts, or when you think that the customer has a high likelihood of not paying. We will discuss these in another video. Please always remember, revenues do not depend on cash collections. If you sell and you are not paid yet, it is still revenues. I cannot stress this enough. Revenues do not depend on cash collections, but upon delivery of the product. Let us make a series of quick examples if a transaction is revenue or not. 1. Cash collected from a credit customer. This is not revenue because you did not deliver your product or service. 2. Cash sale of inventory to walk-in customer. This is revenue because you delivered. 3. Credit sale of inventory to a regular customer on a 30-day payment term. This is also revenue because you delivered. It does not matter if you did not receive the cash. The final one, sale of equipment with an original cost of $5,000 for $6,000 in cash. This is not revenue. Revenues are only for inventories. This is equipment. Just like selling a warehouse, a delivery van, a business unit, these are not part of our core operations. They go under other income that we discussed earlier. Let me do one more. Receipt of $80,000 bank loan. Where is the revenue here? We did not sell anything. We did not deliver anything. We just borrowed money. There is no revenues. One more. Baseball club sells a non-refundable season ticket on February 1 and collects $810. The season ticket entitles the holder to attend 81 home games. The first 5 games of the season are played in April. This is a tough one. There are no revenues. Did you deliver our service? Our service is not giving a ticket. Our service is providing a baseball match. That is going to happen next month. Our job is not selling tickets. Our job is selling an entertainment spectacle. This will be next month. We will recognize the revenues then. Some of you would argue that it is non-cancelable. That means we have the cash for us anyway. That is true. Yes, you are richer technically, but you can still not put that revenues until you provide the service. Accounting is never black or white, and everything is up for interpretation. It is rather shades of gray, like 50 shades of gray. Actually more. We learned when we recognize revenues. How about when do we recognize expenses? Well, just like revenues, whenever the economic activity happens and not when cash changes hands. In other words, did you use the telephone this month? Was the total usage cost $50,000? Then this month you should record an expense of $50,000 under telephone expenses, irrespective whether you pay the telephone company or not. Let me expand on this in a bit. As an example, a prepaid expense or outflow assets, it is like paying for marketing campaigns to be conducted next year. It is not an expense. It is a prepaid asset. No expense here. The marketing campaign happens next year, not today. An accrued expense, I mean, you incur liabilities. If employees work for you this month, but you do not pay them, it is still an expense. Economic activity happened this month. Finally, you have to record the expense in the same period as the related revenues, matching. So if you are having a baseball game, the revenue from ticket sales, the electricity expense, the employee wages expense, all has to be recorded at the same time. Let us do a series of examples. Let's start. $2,000 rent is paid in advance for the following month. This is not an expense. Expense occurs when you use something. We have paid in advance, but we have not used. This is not an expense. This would be a prepaid asset. A utility bill of $1,250 is received for current usage to be paid next month. This is for current usage, so this is an expense. Now imagine we're in the next month, and the utility bill of $1,250 above is paid today. This is not an expense. The expense was already recorded in the month before. Remember, paying cash, that is not an expense. Usage of the apartment would be the expense. Usage of the service would be an expense. Purchase $2,000 inventory on account. This is not an expense. When we buy inventory, cash goes down and we have an asset. Just quickly look at the examples above. We are not poorer. When we spend $2,000 to buy inventory, we have less cash and more inventory. Equity is not touched. When you sell this inventory, then it will be an expense. Now, next, assume we sell this $2,000 of inventory for $3,000. Then we need to record revenues of $3,000 and expenses of $2,000. The expense item will be called cost of goods sold. See, in this example, I sell $2,000 of this inventory. Now it is an expense. It will be under the item cost of goods sold. We match revenues and expenses. In this case, revenue would be $3,000 and the cost of goods sold would be $2,000. This was my shortest crash course possible on the mechanics of the income statement. Hope you found it useful. Accounting is hard. Otherwise, finance professionals would not be the highest earners in society. Read the book multiple times, solve the questions, read the book again and solve again. There is no 5-minute version of accounting. It needs a lot of work, sweat and tears. Well, perhaps not as much sweat as tears. Thank you for watching. It is a pleasure to help you. See you at the next videos. Never forget, accounting is sexy, accounting is fun.